Welcome to Global Markets 360. I'm Tanveer Gill in the Mumbai News Center. It is a busy week for global cues this week as well as the next. With the OPEC still inconclusive on an output decision, oil prices are teasing $60 to a barrel with imminent risk to the downside. The focus is on what could be the medium-term trend on oil prices, given that a consensus so far has not been reached as far as the OPEC members and the non-OPEC members are concerned. And that's the key question. Can OPEC and non-OPEC members and three of the largest producers of oil, which is Saudi Arabia, Russia and the United States, come together and take a decision on how they want to rebalance the oil market? Joining me on the show to discuss more on the story is Jonathan Barrett, an acclaimed oil expert, acclaimed commodities expert, and he will give us some perspective on how to look at the commodity story going forward from here. Jonathan, it's great to have you on the show. Thanks very much for taking out the time. What happens if a desired output cut is not announced, which is 1 million barrels per day, which I'm told is the quantum that can actually move oil prices?
Good morning. Look, I think at the end of the day, I think the market's sort of looking at 1 million barrels a day. I actually think that it's a reasonable number, but it's not that much. If anything, it'll slow the fall of oil, which we've seen as a result of no decision. So I think they need to do something. From what I am hearing, they are miles apart, particularly Russia. Russia really can't come to that party, mainly because Russia, it's right in their winter season, and that's when things are very slow for them. So I think they're miles apart. Let's see what happens. They did say they'll come out with something today. We'll just have to wait and see.
Oh, absolutely. Jonathan, even if, let's say, an output cut is announced, the dynamics and the politics surrounding the oil market is far from over and far from resolved. Do you think that over the course of the next 6 months, things will still be a bit iffy and uncertain on how the output versus the demand equation for oil is managed? And if so, how would that cap prices? What would be the range that would restrict prices to?
Well, it is quite interesting because Saudi Arabia only came out just a moment ago and you know, basically said, well, they've got no, well, they'll make up their decisions. OPEC will make its own decisions. It'll have no sway from the US. But as we know, you know, there is a lot of sway involved. And also, when you look at where the US is positioned now as a net exporter of oil, it's another major player. But I think the US still does hold a lot of sway with Saudi Arabia. Saudi Arabia obviously has the majority sway in OPEC. So I think it will be quite interesting. But let's put it this way. When you look at OPEC Plus and the US, everyone is producing at record levels. And whilst they're doing that without any restrictions, the market will only assume that that glut will exist if the economies remain weak. So I think we have to be guided by that. In my mind, I think pricing should be, I think it's cheap at these levels, believe it or not. And I think people will try and engineer it just a touch higher, maybe back through that $60, $65 a barrel.
From an India perspective, if you were to put a range to oil prices over the course of the next 12 months, I know you've said 60 to 65 if the output cut comes in, but you know, this is an ever-evolving situation, and I don't think we've heard the last when it comes to managing the output as well as you know, assessing the demand environment into the coming year, given all the slowdown concerns that there are. On the downside, you know, so I would cap the range to 60, 65 as per your estimates. On the downside, what kind of range would you give to the market?
Well, I think when you look at India and you know, we've had a 33% bonus on inputs there, so that's certainly got to filter through to the economy and also then stimulate the economy and stimulate demand. On the downside, I really struggle with prices below US $50 a barrel because you know, there are more concerns down there. You know, obviously for the producers. You know, when leading 6 to 8 months ago, we had Saudi Arabia saying that, you know, anything below 50 is a huge issue for them. You know, they've got a lot of expenses, So when you see prices a lot lower, then you start to see there's more tightening on those supply, as we saw before. So I think that as you go lower, more talk, but definitely more cuts.
Okay, my final question to you, Jonathan, as we wrap up discussion on this topic, and the government would be wanting to hear your response on this. For 2019, given that it's an important election year in India, how would you, what kind of probability would you ascribe to steep oil prices, and I'm talking 80 and beyond? What's the probability that that sort of trade would happen? Just because India would be so sensitive in that case.
Oh, look, I don't see it. I don't see it. I've never seen it 80 and beyond, and you can more than welcome to go through a lot of the scripts which I've done on it. Although there are people that say it, I don't see it. I see we've got a new element in the market, that's US production. So I think whilst we've got that US production which really wants to go to the market, and that's what they're aiming for, I don't think you'll see it up around those levels.
Great to hear that. Jonathan, thanks very much for joining us and giving us your perspective on the oil market. That's everything that you needed to know about oil prices, especially from an India standpoint. 80 is a dream now. It won't happen, is what Jonathan is saying. He doesn't see it in the foreseeable future. In fact, as he put it, the upside to the market could be well capped at between the current levels to 65 at best, which I think from an India standpoint is great news. I repeat. Take a break then. When we come back, there's an important event risk lined up for world markets next week. December 11th is when UK Parliament votes on the Brexit deal. We'll talk more about what that would mean in terms of a market impact when we return. Welcome back. You're still watching Global Markets 360. Next week, December 11th, UK Parliament would vote on PM Theresa May's Brexit deal with the European Union. The Prime Minister needs Parliament approval for the deal to be implemented by end of March 2019. The consensus is she will not get the required approval in the first go. But markets are on tenterhooks as such a fallout can increase the risk of a hard Brexit, which will be seen as very negative for the pound and for the UK economy. Let's discuss more on this topic with two special guests, Sanjay Mathur of ANZ and Yan Den of Ashmore Investments. Gentlemen, thanks very much for joining us. Before I come to you, let me get in my colleague Mubina Kapasi to paint the Brexit scenarios for our viewers.
It's going to be one of the most expensive divorce deals we witnessed in the recent past. And I'm not talking about between two people. I'm talking about between two nations or two entities. UK will be leaving the European Union on the 29th of March 2019 at 11 p.m. Both the nations, or rather both the geographies, have agreed on a prima facie deal. It's a non-negotiable deal as per the European Union. This is the deal that Theresa May had adopted in her Chequers plan, and it's been put forward and accepted by the European Union. What's the next step? Well, now Theresa May has a battle to fight at the Parliament. This deal is going to be put to vote at the Parliament. Two scenarios. One, it's accepted. The other is it's rejected at the Parliament. Let's understand the accepted scenario, which is far more simpler, because essentially it means an orderly exit. What an orderly exit means is that there's going to be a transition period until the 31st of December 2020, which will give time for governments, for businesses to essentially adjust to this new regime of having a standalone country of United Kingdom without any trade deals, etc., etc., etc. They're still going to have to abide by all the EU rules. However, they're not going to have any membership of the European Union to have any say on how the rules should be, how the framework should be. So they will lose membership. They'll still be a part of it. However, they'll have to abide by it. And yeah, like I said, an adjustment period for businesses as well as governments to adapt to the new regime. Everything goes hunky-dory. It's all fine. However, the other scenario, and the most scary scenario, however, is the rejection. And this is something I think most market participants are most fearful of, especially if you're doing business in Britain. So if in case it's a rejection, and the most scary scenario is a chaotic exit, this would mean that there's no transition period. Businesses will in fact have to adjust to the new regime instantly. There's going to be chaos in the markets, especially in important markets. Industries like medicine and food will be disrupted. However, it's not necessary. It could be a chaotic exit. There could be a general election once again. It will be put to the Parliament again. A vote of no confidence as well for Theresa May is a possibility, and a leadership challenge, which means in these two scenarios, either Theresa May wins again or there could be a new leader. However, how is it going so far? Let's consider that. Well, first up, it's not going good because she's losing quite a few important legislations. 3 defeats already by Theresa May at the Parliament, and not to mention couple of resignations as well from her cabinet, but only time will tell if Theresa May is actually going to be able to navigate this deal through the parliament.
Thanks very much, Mubina, for that. Sanjay, I'll come to you first because the market reaction would be immediate. In all likelihood, Parliament would not vote for the desired deal. What do you think will happen to the markets, and what do you think will happen to the pound and to the equity markets in Europe?
Well, I think that, the market reaction will obviously be negative. But I do think that when we sort of look at the deal, there is a strong possibility that the March 29 deadline is somewhat arbitrary. It can certainly be extended. At this point in time, however, one of the views that's surfacing is that, we can walk away from a Brexit deal. It can be cancelled. I think that will require a lot more effort. I think in all likelihood, given the state of preparation that we have right now towards it, there is a good possibility that the deadline may well be extended.
Okay. Jan, same question to you. What happens if Parliament votes against the deal, which is the most likely scenario?
Yeah, I think the Parliament is going to vote against the Brexit deal, and that's going to put us into a difficult situation because there are essentially three alternatives here. Theresa May's Brexit plan is really the best possible outcome among a set of bad outcomes for the economy. She has clearly prioritized Britain's economic interests and sacrificed control to Europe in order to protect as much as possible the British economy. But politicians are very myopic. They don't see this as a transition deal. They see this as potentially enslavement of Britain to European Union over a long period of time. So they will reject this. If they reject this, the alternative is that we don't have a deal. And if we don't have a deal, then we go towards hard Brexit in March. And hard Brexit, as we know now from studies from Bank of England and the Treasury, is a disaster for the British economy. So when you're faced with a situation of shall we say, the best of many bad outcomes that you can't go down and the alternative is horrible, well, then the best play, and this is my base case, is that politicians will find a way to play for time. So we're going to see some kind of delay mechanisms, maybe a suspension of Article 50, some kind of method whereby the British Parliament buys time, and then they can sit down and slightly more calmly, perhaps, try to work out what on earth they're going to do, given this conundrum they've managed to get themselves into.
But there's word, Jan, on the street that once the deal is rejected, compelled by the adverse market reaction, which is pretty much anticipated, Parliament will go for another round of voting and take a look at the deal in new light. Would that help?
Yes, that's a possibility. It's very difficult to say exactly what is going to happen, but there is such an overwhelming opposition to Theresa May's deal because, remember, what Theresa May's deal delivers is exactly the opposite of what people voted for. People voted for taking back control from the European Union and obtaining greater freedom to enter into trade deals and so on with the rest of the world. This particular deal prevents us from entering into trade deals with the rest of the world and surrenders power to the European Union. So politically speaking, this is impossible. And I think if the initial market reaction to a negative vote is very bad, then I don't think it follows logically that politicians suddenly vote in favor of her deal. I think it follows more logically that they find a way of buying time. In other words, maybe suspending or reversing the exit temporarily and in order to buy time and then to try to find a new solution. And of course, that may be very difficult and it may take a long period of time and it may require leadership change and even perhaps a general election or a new referendum. But at least if you stop the clock, which we know is now possible because we've had indications from the European Court of Justice that actually the executive, the government in Britain can, if they wish, suspend the exit process. In other words, the referendum in favor of leaving the European Union is not legally binding on the government. So all it takes is really for the government, whoever is in charge, to say, okay, we're not leaving, at least not yet. And that'll buy them time. And I think that's more likely than vast sections of Parliament suddenly changing their mind because of some volatility in the market.
Right. Sanjay, how are you selling the story of UK and Europe to your clients in the wake of this uncertainty that comes into Brexit? And, does this uncertainty become an opportunity for investors to say, look, there's too much of a mess going on here. Let's bet bigger on Asia and some of the key Asian markets because at least there's more calm there. Is Europe's, the negativity surrounding Europe and UK in the wake of Brexit an advantage for Asia?
Well, not really. I think that eventually whereas it's been very hard to quantify, but, Britain walking out of Brexit means a lot to Asia, whether we look at Britain as a financial center, Europe as a sort of important destination for trade. So a lot of things will have to be renegotiated at this point in time. So I would say that investors are concerned about it. Having said that, probably less so than, say, an investor in Europe who's really playing the European markets would be, but there is an element of concern. Now, the question is whether it becomes an opportunity for Asia or not. And I think where we are in Asia today, we do have enough concerns in itself. So first of all, we have the trade tensions between China and the U.S., which sort of at least in this region, that's what's really taking the headlines much more than the Brexit issue. The second is that we have already seen a slowdown in Asia's business cycle. And thirdly, when we just look at the set of problems in the domestic Chinese economy, the deleveraging, the slowdown, all these things are perhaps not presenting a strong investment opportunity at this stage. Had these problems been absent, certainly I would agree with you that we would have seen a lot more inflows into Asia.
So my only follow-up then is, Sanjay, from a market standpoint, what does one take away from the story? Because like you said, we are living in a bit of we are living in a world where while correlations have broken down and have gotten diluted, there will be spillover impacts. So how are you looking at the fallout on the Brexit issue impacting markets globally? And currencies as well, because, a pound is one of the 5 reserve currencies of the world.
Yes. So I don't foresee that, we will see reserve managers really move away from the pound in a hurry. Let's not forget that the pound was also a reserve currency before it joined the EU and before the EU came into being. So I don't foresee that being a major issue. I think that, of course, evaluating the pound will be on the intrinsic business cycle of the UK if, once we have the Brexit, and that would be harder to sort of gauge. In terms of how it really impacts markets in Asia, I think this is one of the many other event risks that we have, going into 2019. So as I mentioned earlier, we have the US-China trade tensions. We have elections in at least 2 large economies coming up next year. Then we have Brexit. So I guess where we have ended up with is that the number of event risks, flashpoints, etc., have genuinely gone up, and that's made markets far more choppy, and I don't foresee any diminishment of this volatility in the markets.
Okay, interesting thoughts there. Jan, what would be the best and worst case scenario for the pound and for the UK economy, as also your UK and European markets?
I think the worst case scenario is a hard Brexit, and I think it leads to a significant revaluation of the pound. It leads to a sustained negative economic growth in the UK. It leads to a significant contraction in the short term, and also to high inflation. So that's a really nasty situation, and I could see the pound, dropping significantly, and we're talking here about more than 10%. If that scenario happens. The best scenario by far, but it doesn't look very likely right now, but who knows? Miracles have happened before, I suppose. It would be if we go back to the people, have a vote, and then a majority of Brits decide that it was a really bad idea to leave the European Union, and then decide to stay within the European Union. That by far would be the best scenario for the pound. And I think we're likely to find ourselves somewhere in between these two extremes, which is probably causes the uncertainty surrounding the economic outlook to linger. And that uncertainty will lead to delayed investments, more retrenchment in consumption, more nervousness, and that in itself should lead to a lower pound over time, but in a slightly less disorderly fashion than if we had a hard Brexit.
Talking about next week, do you think that one can brace for some panic selling and tremendous volatility in just the next 5 days of trade for the world markets in the wake of the Brexit deal, as well as, you know, the uncertainty coming in on crude, which is, like Sanjay said, positive for some nations, but, you know, you never know how the swing factors work.
Well, I think there are certainly, I mean, there are risks galore coming out of developed economies. I mean, or the developed economies, the so-called risk-free countries of the world, if you wish, the rich countries, are the source of 95% of all global risk at the moment. They are absolutely not risk-free. Many of them are heading into serious economic or political problems, or both. So we should expect to continue to see the big tape bombs coming out of developed economies. The good news, I suppose, is that panics never last for very long. After panic subsides and investors cool down a little bit, then they need to start thinking about, well, what do these problems in developed economies really imply? And to me, what they imply is slower growth, less productivity, and that asset prices need to be revalued. And if you think about it in that context, of course, European bond yields are incredibly low. U.S. stock prices, U.S. stocks have gone up 430% since the financial crisis, and the dollar has gone up 50% against emerging market currencies since 08-09. So, in my opinion, asset prices in developed economies are really rather expensive. I think in EM, they're relatively cheap. And when you look at the EM situation, yeah, there are country-specific stories, of course, there always are. But in general, emerging markets look a lot more sane and sensible. And also valuations look more attractive than they do in developed markets. So the strategy that I would pursue in this environment is to say, let's forget our prior convictions about what is risky and what is not risky. Let's look at the facts. Developed markets are very risky and very expensive. That does not make for a healthy return outlook. Whereas emerging markets look relatively stable and their assets are relatively cheap, and that makes for a more sensible place to put money. So my expectation for next year is actually that as these, shall we say, short-term risk factors, the panic surrounding those begins to dissipate, then I think calmer sentiment will lead to an allocation of capital out of these trouble-prone developed markets and back into emerging markets. Like we saw in 16 and 17, I think we're going to see market dynamics very similar to that. So investors should basically ruthlessly take advantage of these risk aversion events. It's a good chance to get into some safer emerging market assets and out of these risky developed markets.
Jan and Sanjay, thanks very much for joining us with your take on this burning issue. It's going to be an important one in the coming week. With that, we come to the end of this edition of Global Markets 360. Thanks very much for watching the show.